Thanks for joining us. I'm going to go through just a bunch of slides related to one of our favorite topics right now, which is regional U.S. gaming. And this is a topic that, I'd say one of the businesses that really changed through COVID and changed for the better. And so you'll hear me reference that quite a bit. The business models changed, the demographic, customer profile changed, and the cost structure changed, both for the better. So we've got a lot of tailwinds in this business, and the valuations are pretty reasonable, despite how well the stocks have actually done since COVID, or since the bottom of COVID. But it's all been numbers driven. So it hasn't been, pie in the sky multiples or anything like that. I mean, these numbers are truly better. And what we're battling right now with the bears is, are these numbers sustainable? Are the top line trends sustainable? Are the margins sustainable? And our answer is absolutely. Relative to 2019, you should see a growthier top line and a much better cost structure. And what we're looking at here is sustainable growth on the top line and margins. And I'll get into why that is. But, essentially, the lack of entertainment options through COVID actually introduced the regional casino to a younger demographic, which hadn't previously gone. It was primarily visited by the baby boomer generation, but a younger generation such as millennial liked what they experienced. And even as some of the other entertainment options actually opened, you saw repeat visitation. It's always the first question I ask management teams when I talk to them is, are these younger customers coming back? Because that was, a bear case for a long, long time, that the baby boomers were getting older and dying off. And where's the new customers going to come from? It wasn't going to be Generation X. They weren't coming. Millennials weren't coming. But that's all changed. And so far, it seems like it's changed for the better. So that's driving a lot of the top line. On the bottom line, these guys just realized that they don't need loss leader, money-losing amenities like the buffet. That's the perfect example. They didn't make any money off the buffet, but because the guy next door had the buffet, and they thought it was a good idea to have a buffet, and it was also a good idea to send out expensive mailers to people who weren't going to spend too much money. So a lot of the marketing and the promotion stuff that was already kind of undergoing a change there, meaning that they were already starting to cut those costs out. COVID really pulled everything forward and allowed these companies to really focus on where they make money, and that's on pure gambling. Now, some companies like Penn and Boyd already had a structural advantage in that most of their revenues by a huge margin came from the gaming side. So their margins are probably maybe more protected than some others. And we'll get into the details there. So that's what's happening on the cost side. Point number 2 here is cash flow generation. This is, I think, the next leg of the story that people aren't really focused on. These companies are generating huge amounts of free cash flow and delevering at rates we have never seen before in the gaming industry, or in a lot of my industries. So you went from very highly leveraged companies just 2 years ago to companies that are going to be actually like Penn and Boyd. Boyd is already at their kind of target leverage with very few capital needs. So tons of cash flow are going to be coming in. What are they going to do with that cash flow? Well, just buying back stock alone adds a ton of value, especially at these levels. It's incredibly accretive on an EPS and free cash flow per share, which we care about more, basis. And, historically, everybody's looked at EV to EBITDA, and I think that's going to change given, how much accretion they can actually generate on a per share basis.